Hello everyone, welcome back to another update on our Lunch and Learn webinar series. My name is Mayur Thaker. I'm an analyst and co-portfolio manager here at Zacks Investment Research. And I just wanted to give you a quick update on several important macroeconomic indicators that I'm particularly watching and using all of that information to build a case as to why I believe inflation has likely peaked. But then also, more importantly, is to know the why behind that, which I think holds the key to understanding where we go from here in the equity markets. So let's get started and let's take a look at some of these updated charts here. So the first chart that I've been kind of presenting over the last several months is drawing the connection between the high inflation that we have been seeing with backlog. And remember, this is a very direct relationship. As the backlog increases, prices increase, and vice versa. And now we've seen a steep drop off in the backlog, which basically has undone the entire run up during this inflationary period of 2020 to now. And so I think that that is going to put significant pressure on prices to come down, and we've already seen the peak in the CPI year over year. So I believe we're about to see inflation come down quite substantially. I can't give you an exact number, can't say that it's going to be below 5% or 4%, but in general, I believe that inflation on a year over year basis will be coming down. And if it stays this low, I'd be pretty confident even stating that we might actually see inflation be negative year over year. And that would still not be enough to get us back to prices that we used to have back in 2019. But still, that's the direction that I think the Fed wants to see things going before they slow the pace of rate hikes. But that's the first important chart that I wanted to draw. We're already starting to see prices come down at the supply side level. So this is the ISM Manufacturing Prices Paid Index. This is the prices that manufacturers pay for raw materials and other input costs, and we've already seen that fall into contraction. So this has to happen first before consumers can start to see easing prices, and that's what we're starting to see here. We've now prices have come into contraction. This number is now below 50, and we haven't seen prices come this low really since the early part of the pandemic, but we've also seen it back here in 2008, 2009. So I think that's what's happening now going forward. So I believe that prices have peaked in terms of the rate of change, and we should start to see easing prices now in the near term future, meaning over the next 1 year or so. So the evidence, however, is building that the key reason for falling prices is easing demand. And we can see that from the new orders index. This is, again, another subcomponent of the ISM Manufacturing Index. This is the new orders index, and we have now started to see that this is, showing some signs of cracks. We've now been in contraction for, 2 straight months. And I think this is going to continue. This is a trend that has now begun that we really haven't seen since the early part of the pandemic. But prior to that, the only time we've seen prices come this low was during the great financial crisis of 2008, 2009. I'm not saying that things will necessarily be as bad as it was back then, but again, these are all indicators pointing towards declining demand. And then again, anecdotally, the Chicago PMI is another very important index that I want everyone to keep track of. I think everyone should be watching this number very closely because this is the manufacturing index for factories that are located in the Rust Belt of the U.S. And this is very important as well because this shows kind of economic activity in the heartland of America. And anecdotally, you can see that I've highlighted here that the bottom left corner. You can see it says weak demand conditions saw 46% of firms experiencing falling orders. So again, that kind of corroborates with what we just saw in the previous slide, with the new orders index sliding into contraction. And you can see on the chart right here on the screen that we're actually at the lowest levels since, again, if you were to exclude the 2020 pandemic, this is the lowest Chicago PMI we have seen since 2008. So this is signaling a deepening downturn in economic activity, and it's being driven by weakening demand. So we have seen evidence that there has been demand destruction for a variety of reasons, but the ultimate fact remains is that demand is weakening, and therefore production is weakening. That's what leads to job cuts eventually, and that's what we're starting to see here. And then, adding pressure to equity markets furthermore is the Fed removing liquidity at the same time. So we're seeing building recessionary pressure, and we're seeing aggressive liquidity removal. Now, I personally am in support of this. I think that the Fed really should be removing liquidity because we've seen extraordinary monetary policy that needs to really come back to reality. You can see what happened to M2 money stock. This is the total amount of money that's in circulation that's within the hands of consumers, really, in bank accounts and whatnot. And so this really skyrocketed well above long-term trend growth. So this number really needs to come back down to experience mean reversion. And so we're starting to see the year-over-year M2 growth rate basically come to flat and almost will now most likely be negative year over year. And that would be the first negative year over year, reading for M2 in 60 plus years. So we're truly in unprecedented territory, but I think it needs to happen just because, we, went through just the most radical monetary policy experiment in the Fed's entire history of 100 plus years. So, in order for inflation to come back down, we need to see, the money supply come back to long-term trend. And that's not such a bad thing. But, again, for all intents and purposes, that does put pressure on equity markets. And then, again, another reason why we saw, rising prices in 2020, 2021 was, the cost of shipping skyrocketed, to roughly $18,000 to ship a 40-foot container from Shanghai to LA. That number has come down precipitously now, and it's basically round-tripped that entire move. And anecdotally, again, they are saying that there have been blank or canceled sailings, which is partially, triggering this reversal in the inflation of shipping costs. So again, this is demand destruction driven deflation. So deflation can be good if it means that supply has simply caught up to demand, and demand is right where it is. But this is deflation due to demand destruction, and that's not a good thing. That's recessionary in nature. So that's what we're seeing here, again, anecdotally. And another sort of indicator here as to what's happening with prices, this is the Manheim used vehicle, the used car index. This number is finally starting to come down to reality. So again, just like the M2 money supply, it's interesting, this chart actually looks a lot like M2. That's, a topic in and of itself, but you can start to see that, mean reversion is happening to prices. And the same thing we're starting to see with housing as well. The median home sale prices are, basically reverting back to long-term trend growth. And again, that's not such a bad thing. But it would, again, place pressure on the equity markets because, again, higher prices, higher stock prices, higher asset prices is what creates the wealth effect. And so that also supports, stock prices. But, once that reverses, that's going to cause some pressure on stock prices. And we're starting to see that, for example, if you overlay the Chicago PMI on top of the S&P earnings growth, look at the incredible correlation that you see here between S&P earnings growth and the Chicago PMI. It's a very, very strong relationship, and so that's why I think everybody should be paying attention to the Chicago PMI very closely. And look what's happened to Chicago PMI, as we saw just a few slides ago. So I think this basically almost assures us that we are going to see S&P growth come in negative on a year-over-year basis. I would not be surprised to see earnings growth drop 10 to 20% year-over-year next year in fiscal year 2023 versus 2022. That's certainly what the Chicago PMI is telling us right here. So again, this is all sort of supporting the broad thesis of recession. So what drove earnings higher initially was the wealth effect. That can be a major driver upward as well as downward for stock prices. So housing prices are cratering. We know that there's a record number of cuts to list prices according to both Zillow and Redfin. This has been triggered by soaring interest rates and mortgage rates. The used car market has started to show signs of cracks. Demand has definitely eased significantly, which is putting downward pressure all across the board. So whenever the wealth effect moves in the opposite direction, that can also translate to earnings weakness for the S&P 500. So again, that's another reason why I think we may see earnings come in lower next year than this year, which again is consistent with what typically happens in a recession. And now we can actually start to see analysts are exactly predicting that. So we've been kind of talking about this for several months now, but you can start to see that analysts have really started to slash their estimates at an accelerating pace ever since we got Q3 earnings. And now you can see that these are the revisions to Q4 estimates. Just prior to the start of Q3 earnings, analysts were expecting basically flat, roughly just 0.4% growth year over year for Q4. Now that number has been revised down to minus 6.5%. So the contraction year over year has officially begun. And this is with energy. If you remove energy stocks, oil and gas right now are the rare sort of strong, areas of the market. But if you remove energy, it's, even worse at roughly 10.8%. So that's everybody else, minus, oil and gas. And then if you look at, aggregate 2023 numbers, the same idea holds that this number has been relentlessly brought down basically all year, really since April, where we hit that high water mark. This is, again, a calculation that we do here at Zacks internally. This is just another method for arriving at aggregate S&P earnings. And that number has been slashed quite significantly here by, more than 10% now, down to, 1791 from a peak of 2032. Again, this is X oil and energy stocks. So I believe this is going to continue to come down. My expectation is for, roughly, 10%, 10 to 20% contraction in earnings. So basically my takeaways from all these charts here is that a recession is imminent. I believe we may start to see that in Q1, according to the official data. And the data currently suggests that it's going to be of garden variety. So, recession is a big bad word, but, there are varying degrees of severity in recessions. And as of right now, I think it's going to be garden variety, which means roughly 10 to 20% decline in S&P earnings growth year over year. Unemployment to rise, we're already starting to see that. We're starting to see that anecdotally. By the way, with one thing, I didn't show it in a chart here. I will do that on our next update. But while the jobs number has been very, very strong recently, it's been outperforming estimates. A major caveat to that number is to look at the aggregate hours worked. If you look at the aggregate hours worked subcomponent of the jobs report, that number has actually been coming down all year steadily, which means that even with strong, job creation, it means that if the total number of hours worked is in decline, that's, a major caveat to the headline number. If we are seeing strong job growth, then we should start to see aggregate hours worked increase. But it's not. And the reason for that is because of decreasing labor productivity, but also decreasing labor participation. So that's another thing to keep an eye on, is the aggregate hours worked needs to confirm the jobs number. And if it's not, it means that there's fewer total hours of labor that's working. That could mean that there are more part-time jobs. That could mean that, people are exiting the workforce for a variety of reasons. It's, a number of different reasons. We can unpack that in a different call. But keep an eye on that. Aggregate hours worked needs to start going up, and it's been going down all year long. So I think that's a precursor to unemployment rising, inflation to cool off from current levels. S&P earnings are likely to decline next year versus this year. My best estimate is that the S&P should come to a 3150 target. That's roughly 20% lower from today's levels as of today's recording. And I arrive at that by just simply estimating $210 in aggregate earnings per share. That's roughly 10% lower from the 2022 numbers. So it's not a big hit to earnings. And then just putting on a average recessionary multiple, and that's actually a little bit on the high end too. So even if you were to take a little bit of a conservative approach, you can still see that I think the S&P has quite a substantial move to the downside to go. So if I were you, I would be steadily dollar cost averaging. I think we're closer to the bottom than we are to the top, but I would be expecting and sort of preparing clients to expect much lower markets in the coming months, and that would be a great time to start adding to equity exposure once again. Long term, I think the market is in a very, very strong shape, but short term, I think there is some turbulence ahead, and it would be a great time to allocate capital back into equities if we do get to this level of 3150 or so. But again, I do expect that to happen. So that would be a pretty deep bear market from today's levels.
The key word.
So again, in summary, if there's nothing but uncertainty that we're looking at here. So the way to sort of prepare investors and to position the portfolio is to invest in companies that make critical products and services, right? Companies that have a proven record of consistent earnings growth on attractive ROIC, even through recessions. And that's exactly what we do with the earnings certain portfolio. And that's what we see here. This is just an aggregate chart of the earnings certain portfolio. You can see how well these companies do on an aggregate basis on earnings growth through recessions. Just a phenomenal portfolio of long-term compounders that continue to grow even through recessions. You can see it's got better stability and faster cumulative earnings growth versus the S&P 500. So again, why put yourself through agony of owning deep cyclicals like this? These are the types of companies that you would get if you are a plain vanilla index investor. Why would you put yourself through this type of a agony when you can own these types of quality companies that continue to grow even through recessions with a high degree of certainty? So this is exactly the portfolio strategy of the earnings certain, the Zacks earnings certain proxy. That is the portfolio to be in. And you can see that our performance year to date has done exactly what we would expect it to do. Again, the Zacks earnings certain proxy is a portfolio of high quality businesses that have high long-term earnings visibility. They have high returns on invested capital, They have, as a result, faster cumulative earnings growth. They are a collection of low beta stocks, so they do quite well during downturns. They, have big outperformance during bear markets and slight underperformance during very strong bull markets. So the net result of that is actually better cumulative and risk-adjusted returns over a complete market cycle. And the performance so far this year has been just under 5%. So we're down about 5% year to date through November 30th, 2022 versus, minus 13% for the S&P 500 over that same time period. So we're doing quite well relative to the S&P, which is exactly what we would like to see, and that's exactly what we expect. And these are some of the companies that we own in the portfolio. Just high quality, very strong brands, companies that provide critical services that are always in demand, regardless of what type of economic situation we're in. So hopefully that helps. Thank you again for attending. I'd love to hear from you if you have any questions. Please reach out to us if you are a ZRS client. Send us an email at zrs@zacks.com. And if you are an Advisor Tools client, please send us an email at zat@zacks.com. All right, thanks everyone, and talk to you soon. Hope to see you on the next one. Take care.